is one of the best known and most influential people in the resource mining business. And we are delighted to have him here today as a return guest on SBTV. Good day, Rick, and welcome back to SBTV. How are you doing?
I'm doing very well. It's very nice to be back with you. Thank you.
Thank you. We're glad to have you back again. Rick, 2019, it's been excellent for gold so far, with the price of gold reaching 6-year highs. Now, I'm aware that you are very much a long-term investor, and you've often said that bear markets are the author of bull markets. Now, if you could, can you distill the cause for the rally in the gold price this year to one reason? What would it be?
Diminished faith in the long-term purchasing power of the U.S. dollar, particularly as expressed by the U.S. 10-year Treasury. The U.S. 10-year Treasury yields are now in negative territory after inflation. So the suspicion among global investors is that they will enjoy, if that's the right phrase, a diminishment of purchasing power by owning the U.S. 10-year Treasury. That does two things. It lowers the attractiveness of the bond relative to gold, and it also takes away the key reason not to own gold, which is the averted yield. If people could earn a positive yield owning the Treasury, that would mean that there was, in effect, capital rent to own gold. Jim Grant refers to gold now as the honest zero return, as opposed to the negative returns available in sovereign debt, including now the U.S. 10-year Treasury.
Okay, honest zero. Never heard that one before. But in your opinion, are you convinced that gold has entered a new bull market?
I am. That doesn't mean that what a speculator sees from here are stair steps to heaven. Bull markets back and fill, and so it's entirely likely that gold, and in particular gold stocks, will give up some of their gains and build a base and grind higher. What I really like, in fact, about the gold market this year is that it hasn't been a hockey stick chart.
Yeah.
You know, it hasn't been straight up, but rather it has just been grinding higher. And what I like even more is that the equities haven't rocketed higher based on gold strength. The subdued nature of this gain, to me, is evidence of market breadth and strength.
From your experience witnessing cycles of asset values from overvalued to undervalued, how long do you expect the next gold bull market to last, at least?
I'm too old to fall for that. A prediction that I could get caught up in is something that at age 66 I avoid strenuously. I'll tell you this. I've studied a chart recently. I'm not a technical analyst, but I've studied a chart, the Barron's Gold Mining Index. And it's very interesting. Going back 40 years, the up cycles have varied in length from as little as 9 months on technical rebounds to as much as 6 years. What's equally interesting to duration is the magnitude. The magnitude is truly stunning. Of the 11 up cycles that I studied on the graph, the worst of them generated 150% return in the equities. The best of them generated 1,200% return in equities. The question you're asking me, I think, has three parts. Are we in a bull market? And if not, when will it start? What is the likely duration of that bull market? And what is the magnitude? And I can say with confidence to all three, I have no earthly idea. What I can also say is that if you look at that chart, we are either approaching at or just off the bottom. The upside has somewhere between 9 months and 60 months. If you follow the thesis that you opened with, that bear markets are the authors of bull markets, the bear market that we've been through in the period 2011 to 2019 was at once very long and very deep. That would suggest that the recovery could be similarly long. Time will, of course, tell. What's more important in this context, I think, than discussing history is looking at the fundamentals. And the fundamentals really go, I think, to fiat currencies around the world in negative yield categories and their impact on the US dollar. Because I really think that the most important variable with regards to the gold trade and the gold equities trade is faith in the long-term purchasing power of the US dollar, which the US government seems to be doing their very best to undermine.
Yeah. I mean, speaking of the US dollar, President Trump's recent tweets, he's calling on the Fed, where are you, Fed? And he wants a weaker dollar. When do you think we're going to start to see a weaker dollar relative to other currencies?
Well, I don't think you're going to see a weaker dollar relative to other currencies. My suspicion is, measured against other currencies, both gold and the US dollar will do well in the next 18 months. The Germans sold 1.2, I think it is, billion euros worth of a 30-year negative yield bond. This may be the first time in history that a government has made a long-term promise that will come true. The German government looked at bond buyers and said, we absolutely, positively guarantee that if you give us money, we will give you back less than you gave us. This is a promise that a government can keep, but it's also a promise that a government can keep. It's also indicative of the fact that you lose less purchasing power in the dollar than you do in the euro or the yen. Doug Casey famously describes this circumstance as saying that the US dollar is the prettiest mare at the slaughterhouse. So the US dollar will be relatively rather than absolutely strong. But the promise of risk-free return, which is what fiat-denominated bonds are, is now, I think, concerning enough that we're beginning to see the generalist investors come back into gold because there's no reason not to, and there are solid reasons to, all of which are put up by debt.
Okay. I from watching one of your videos, I understand that precious metals assets share of investable assets in the U.S. today is less than 1%. How do you see the demand for precious metals assets with the renewed interest in gold that came with the recent price rally?
Well, let's talk about that arithmetic a little more, because that's math talking, not Rick talking, and math can be compelling, I think. The actual number is less than 1/2%. Precious metals and precious metals related securities comprise less than 1/2% of savings and investments assets in the United States. At the top of the epic bull market of the 1970s, in fact, all the way to 1981, precious metals and precious metals investments comprised 8% of investable assets in the United States. The 3-decade mean was about 2%. So if precious metals and precious metals assets attained their mean market share over 3 decades at 2%, demand for precious metals and precious metals equities in the United States, which comprises 24% of investable assets in the world, would quadruple. I'm not one of those who suggests that gold is going to win the war against the US dollar. I think gold is going to lose the war less badly. And I think that will be potentially dramatic for precious metals and precious metals equities.
Okay, so if those numbers are true, which of course they should be, more people will be coming into gold. I'd imagine more people will be coming into silver as well.
That's another topic if you want to go there. Some people come into precious metals, interestingly, for 2 reasons: fear and greed. The gold trade that you're seeing right now is not momentum oriented. People aren't flooding into gold because it's up 14% off its lows. People are flooding into gold because they're afraid. Later in a bull market, when precious metals have moved, momentum traders come in, the greed traders. And the people who are interested in precious metals as a consequence of cashing in on a bull market, maybe the equity investors, historically have done better in silver, and better yet in silver equities. Silver moves later than gold because the bull markets are always kicked off by fear but extended by greed. But silver traditionally has been more volatile to the upside and the downside, meaning in the bull market, it outpaces gold. But the best speculative asset class historically has been the silver equities, that is, leveraged calls on silver. That's because silver stocks are very rare. In down markets, they go almost extinct. High quality silver equities are rarer. There are probably 10 or 12 silver equities in the world that an experienced analyst could recommend with a straight face. And in a precious metals bull market, the rarest, most leveraged asset class ultimately moves the furthest. And one would have to suspect, if past is prologue, that when this bull market gets underway, for those people who have the courage and can handle volatility, the high-quality silver assets will be the asset class to be in.
Yeah, it's interesting. The last bull market from 2000 to 2011 saw many mining companies increase their capital expenditure to buy equipment and also to acquire new properties. When the bear market happened, many of these companies had to cut back their expenditure, close or sell off mines that were not economic to operate. With the gold price at 6-year highs, how big of an impact does it have on mining companies right now?
We're starting to see cost pressures in the mining business right now. We're starting to see cost pressures for a couple of reasons. The first is that the margins in the industry, particularly in Australia, have been strong enough that the company's costs of capital have fallen. And they're trying to make up for lost time. They are trying to invest to make up for the fact that they weren't able to invest in their basic businesses for the last 7 or 8 years. The other thing that you notice is that during lean times, companies mine material that has a higher average grade than their median return grade. This is a polite way of saying they high grade. And when they high grade, their unit cost falls relative to their income. When the gold price recovers, or the silver price recovers, when the metals prices recover, they go back to mining the median grade, except for that the median grade has gone down because they pulled out the high grade material. So costs will rise even if expenditures don't rise, because the industry has pulled material out of the ground that was higher than the average grade of their resources and reserves. So the cost pressures that you talk about will occur both in the context of investing, but also in the context of amortizing prior high grading.
Okay. We're on the topic of gold equities. I came across a recent video again from Sprott Media where you talked about investor psychology and asset valuation cycles using the Barron's Gold Mining Index, which we talked about a little earlier on. And it was really a gem of a video, and I encourage all of our viewers to go ahead and look at that video on YouTube and watch it as well, and subscribe as well. But for our viewers who have not yet watched that video, can you explain why is it that you say you are either a contrarian or a victim?
Well, I think that video, the chart, shows it dramatically. Most people react to a narrative when it has been demonstrated by price action. Von Mises described this as recency bias. Our expectation of the future is set by our experience in the immediate past. And if our experience in the immediate past is good, we become more aggressive. Or if our experience in the immediate past is bad, we become less aggressive. So ironically, when assets are overpriced, when the price action justifies the narrative that would cause us to buy them, we become more aggressive. In other words, we prefer overpriced goods because there's confirmation of the narrative that would cause us to buy them. Simultaneously, we avoid underpriced goods for exactly the same reason. If you look at that chart, the 40-year chart, you will see